Good afternoon, ladies and gentlemen, and welcome to the NIGHTCAP PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Sarah Willingham. Good afternoon.
Good afternoon. Thank you very much for that introduction. And hello, everyone. Great to see so many people, actually. It's always a shame that you can't see everybody's face. I always think these things would be so good in person, but great to see so many people join us. So very much appreciate it. Hoping a lot of you already know quite a bit of our story. So this is much more of an update rather than going through the whole story of why NIGHTCAP started 2 years ago and how we got here. But I will just quickly recap. So we'll take you through the results, and Toby will talk through some of the numbers and then some of the recent things that we've done within the business. So just a quick reminder, our mission 2 years ago when we launched NIGHTCAP and IPO'd was to become the UK's leading bar group. And we are well on our way to that today with 36 bars in 2 years. We've acquired 3 businesses. And our plan is to continue to grow at this. We are a consolidator, so we'll continue to look for acquisitions, but also continue to roll out. And actually, we opened 6 last autumn and have opened 13 bars since acquisition of each of those brands. So our plan is to continue to roll out organically, but also to buy other businesses that we can roll out nationally and organically and maximize where possible efficiency savings. And actually we've put that in as a recent addition, because when we bought the first 3 businesses, we very much ran them as independent businesses with the sort of group structure on top. And what we've done in the last 5-6 months, and that finally that's sort of finished, and we're now very much in a group structure as at the end of January of this year. So February's P&L is the first P&L where we're really starting to see all of that come through and starting to see the teams work together differently. And what that means is that we've moved much more into a group structure. So it's NIGHTCAP runs 36 bars, and we have one group managing director. We have a group commercial director who is very much focused on looking at the deals that we can find and the efficiency savings across the group. And he's already making some significant differences to us, actually saving us hundreds of thousands of pounds already. So that's sort of broadly where we are today. So I'm very happy that we're working in that group structure. It's not been easy for the teams, but they're working extremely well. And actually it's making us a lot more efficient. I don't think we need to introduce ourselves again. I think everybody knows by now, probably very bored of that slide. Toby, do you want to take us through some numbers?
Absolutely. So for the 6 months finished 1st of January, we've seen a 49% increase in revenue to 23.5 million. We've seen our adjusted EBITDA increased by 25% to 2 million. Which is, I think, in the contents of the macro environment, a fantastic result. I think you will have seen from our trading updates and our interim results where we have been impacted by the rail strikes. There's been 13 events in the 6-month period to January 23, which has probably, we estimate it's cost us around 8% of our turnover in that period, which by our sort of flow through, because it's the later nights and so a higher margin flow through, it's probably cost us circa 1.2 million of EBITDA. So if you take that into account, our underlying business is extremely strong, and we would have posted an even better set of numbers. In terms of cash flow, I think our net debt has gone up by just under 4 million in the 6-month period, which is basically broken down into the 2 million generated in EBITDA, offset by the 6.1 million spent in capex and pre-opening for the 6 sites that Sarah said we opened in a 6-week period in sort of September or October of this year. Underlying cash flow, we probably generated free cash flow of sort of circa 1 to 1.5 million. Now, this is primarily due to bringing the 3 businesses together as the integration, as Sarah mentioned, and being able to get better terms and better deals and just make the cash work better for us. So whilst it's the EBITDA less the capital expenditure, we've obviously had interest costs and issue raise costs, because one of the other things we elected to do as a exec was to hedge our interest rates, whereby we fixed it at 3% in late summer. Annoyingly, just missed 2.5%, but picked up 3%. And so, particularly happy, given a lot of other people in hospitality haven't done that and are now being hit significantly by this interest rates as they have risen in the latter half of 2022 and could potentially rise in 2023. We don't have that headache on us at all anymore. It means we can spend more time focusing on driving the business forward. So all in all, it's a pretty good 6-month period.
Hang on, let's go back. There we are. I was laughing because I think we're all trying to move the slides. That's my fault, actually. Sorry, Michael. So yeah, thank you, Toby. Brilliant. I think you've already covered most of the things in this slide. You've talked about the like-for-like growth. Christmas was a really incredible period for us. We back in September, we acknowledged that this was not going to be an easy period. And we actually thought that this half of the year was going to be very, very difficult. It's proving to be a lot better than we'd anticipated. But we thought that Christmas was going to be a real struggle because of interest rates, because of energy bills, and actually the general sort of sentiment around the consumer. But we actually had a real record-breaking Christmas. The teams worked very, very hard across all of the bars, and we even had a New Year's Eve that was almost entirely sold out across the entire estate, which we've never seen before. So we were really proud of our performance at Christmas. Oh, Toby, you're on mute.
Oh, sorry, I was going to say we're just under 28% up on last year, just to put it into context.
Yeah.
I'm not going to touch the slide this time.
I think, one of the things that we looked at, and one of the things we felt has been very successful in these first 2 years, the acquisitions we've made, the 3 acquisitions we've made since IPO, we all bought on the basis of their adjusted numbers back in 2019, because it was the last full year of operating that most businesses had. And over that period, we've increased, despite the various macro issues and the underlying, cost of not having a clear run because of the rail strikes, we've still had a more than a 10% increase in like-for-likes, which is certainly demonstrating that the businesses that we've bought are solid and that they've integrated well, and that we've continued to find good upside in them as we move forward. And this is really how the picture has built from the IPO in January 21 through to the various acquisitions, and then the 13 sites building up to this estate of 36 sites that we've now got across our 4 main brands, which are the Cocktail Club, Barrio, Tonight Josephine, and Blaine Gloria. And there's, we absolutely feel that there's significant upside across the country as we move forward. We've seen one of the things we've worked hard at is to see how this cluster model of having several brands in towns can have, and as we can see, for example, in areas like Bristol, it's actually the same in Shoreditch, and now also around Birmingham, is that we're opening several sites within walking distance of each other, and those sites are still trading incredibly well and are not cannibalizing each other. which just shows the potential of going from that 36 to hopefully 150 bars, which we have identified, and we can see our route through to. If we can have 4, 5, or 6 or more in Bristol, and we can certainly, to the 3 we've got in Birmingham, we know we can add a whole bunch in Birmingham as well, without any risk of cannibalization. So when you spread that across the country, there's a rich availability of opportunities, provided that the property opportunity or the acquisition opportunity remains as favorable as it is today.
So the macroeconomic pressures, of course, is something that we are very, very mindful of. I mean, the last time we came and talked to market, which was the end of last year, in November last year, with our full year results, we were pretty pessimistic about the outlook, and wanted to, the feeling very much across the entire industry actually was like, batten down the hatches. We're so much less pessimistic today than we were then. Actually, trading has continued very well into this year, and after having a fantastic Christmas, we're a lot less pessimistic. But let's talk about 3 of the main pressures that are affecting hospitality, and what we've done and where we see ourselves in terms of mitigating that risk. So energy is of course a really big one. Now, most of our energy contracts will still remain well into 2023 and some into 2024. We've just had 6 that have been released, and we've managed to get those at 28 pence per kilowatt hour, which is a really good price. So we feel that we are well covered in terms of our utilities. We don't have the exposure that a lot of other people, unfortunately, have had. Supply chain pressures, we've just not seen it at all. And that's because we have grown so quickly. So we've gone from 3 small businesses negotiating contracts to 1 large business now, negotiating on behalf of, with a run rate of 50-60 million turnover, means that you're having a very, very different conversation when you speak to the likes of, let's say, Bacardi, or it might be an insurance broker. Even looking at the commissions that we might pay on our sales, the systems that we might put in, all of these things, when you look at it and you start to look at it from the size of business we are today compared to what we were a year ago, we are able to negotiate much more beneficial rates. And as a result, our GP is better than ever today, without compromising at all on the quality. And that's even though we have extended happy hours, we have our brunches still on a Saturday, sometimes on a Sunday, which is slightly lower margin. We're still seeing our GP outperform what we've seen in previous years, and that's because we are able to purchase better. Wage inflation, we already paid the national living wage, and actually I would say the toughest time for recruiting staff was by a mile coming out of COVID. Was very, very difficult. There was a real shortage of labour, and also people moved very quickly. They were getting a better offer somewhere else for another £1 an hour, and people were just leaving. We're not seeing that as much today. One of the areas that we've spent a lot of time and been very focused on is on our management training. We've always been, the Cocktail Club's always been world class at its bar training, and we've really got that very, very well known for it. Where we were coming short, for sure, was in our management training, and people weren't seeing that career progression of, okay, once I get to here, where else can I go? Well, now actually we're helping them to learn the business side of running a bar. And also as we grow, there are so much more opportunities for people to grow with us and actually see that hospitality is an amazing career. It's the funnest industry, and you can make a very, very successful career out of it. So that's a big part of our focus that we're seeing now. Rail strikes, Toby talked about this. We have calculated that that's cost us 1.2 million EBITDA last year from July through to the end of December. And they are real numbers. They are us looking at December and saying, well, we were budgeted to turn over 1.5 million. We took 1.5 million last week. we take 1.3 million the following week against budget. And then this week you take 750,000 when there's two rail strikes on that day. The rail strikes have a really significant impact on us. I've been very vocal about this in the press, if anybody follows the things that we talk about. But it's the single thing that for us is the thing that moves the needle the most, actually, out of all of these macroeconomic pressures. But we are seeing light at the head of the tunnel. So we are hoping that there will be some kind of agreement that will be reached soon, and not everybody is still striking. So we have this week's strikes. We're really good at mitigating as much risk as we possibly can. But there is, of course, a limit to what you can do when people just can't get around the country. It doesn't just affect London, it affects the high street, it affects retail, it affects hospitality. And yeah, it's I think it's one of the most destructive decisions that have been made and that the government has allowed to happen, actually, in a long time.
Because in the context of the difficulties that we've seen from the rail strikes, of course, we are incredibly happy that we're still significantly up in both revenue and EBITDA. But one of the most important metrics that we look at, and this speaks a lot to our ability to deploy capital efficiently, is that of the 13 sites that traded until the end of the period, those 13 new sites had only been open on average for just over 6 months at the end of the period, and yet several of the sites were already beating the 75% ROI target that we have in year 3 from those sites. And that's despite these headwinds. And that, I think, the important thing around that is simply that the timing of us rolling out has been such that the property market has been so attractive to us that despite the macro headwinds, those sites have done so incredibly well. And the way we see it, where we've always talked about return on cash in 2 years and an absolute ROI of 75 from year 3, we are on track to achieve across the estate.
So this has been a really big project that we've undertaken within NIGHTCAP since we started working on it at the beginning of September, and this is the integration of the subsidiaries. So as I talked about earlier, we bought 3 individual businesses and they ran independently. So we had 3 head offices, which for a while works, but once you start to understand the businesses, ultimately they have to be integrated at some point. So what we were doing in the background, working with the teams, was sort of underpinning each of those businesses with the same systems, the same financial structure, so that actually they could all work together within a group. So having moved those, we've almost really dissolved the subsidiaries, and now NIGHTCAP runs the 36 bars. And what you see there is a much more efficient structure that we could grow much quicker, because we now have more of a traditional structure where we have a head of people, a group managing director, a commercial head, a group finance director that runs all of the businesses. So for example, if we were to go ahead and buy something new, we would very simply be able to bolt that on within our existing structure after a period of time of integration, of course. But now the beauty of that is that you start to see exactly as Michael said. So we've got Bristol, where we've got 4 bars all very close to each other. We've got 3 of them all within sort of 200 meters walking distance. It means you can start to say easily, if somebody phones Blame Gloria and wants to make a booking on a Saturday and they can't, we easily pass them over. The same person then passes them over to Tonight Josephine or passes them over to the cocktail club. So we're able to really not just maximize our efficiencies across the group, which in the ways that I've already talked about, purchasing, but also really leverage our skill set. So we've got some great people working across all of the brands now, and we're able to share a lot of that skill set very, very easily, whilst not diluting those brands at all. And we have brand ambassadors that are obsessive about making sure that the brands themselves are not diluted. So the consumer has no idea that they're walking into different nightcap bars, because they all look and they feel very, very different. But underlying, there is a beautiful, simple, replicable business model on all of them that we're able to compare and run together alongside each other, where we can absolutely maximize the efficiencies. And it's been a big move for the business, really big move, and I can't underestimate the impact that it's had on a lot of people. And I just cannot thank our teams enough for everything that they have done to make this work. And they've come back this year, this calendar year, full of energy, full of motivation, really excited about their group roles, and absolutely ready to go. So it's been a great decision for the business, and it's been taken very, very well. And in addition to that, we've made significant savings as a result of it. So to recap, we are well on our way to building the UK's leading bar group. We've got a number of really key and exciting brands that we are backing and are rolling out. And now we're in a structure where we could continue to add to those brands. We talked about the numbers. We're up nearly 50% in the group revenue for this last half. 10.1% increase in group like-for-like against 2019. And had it not have been for the rail strikes, actually in the last half, we also would have been up positive actually in the last half against the year before, which was a very buoyant year. We opened since July, we opened 2 cocktail clubs, 2 Tonight Josephine's and 2 Barrio bars in the interim period. As Michael said, our objective, we always fight for where we spend that pound within the business, against each of the brands. They all battle for it. And the businesses that we've opened, actually with the exception of one, all 13 are well on their way to that 75% ROI. And in fact, a number of them are really exceeding the model, beating the model and exceeding expectations. So we're very, very happy with the way that we've opened. And it again proves to us the model as we look at the rest of the UK. Haven't even scratched the surface yet of the cities that we can go to, and the number of bars that we can have. So we can see a very clear path to 150 bars. As we talked about, there's still a continued attractive environment for further acquisitions, but also property. When we originally started NIGHTCAP, we thought that there was going to be a property window of about 2 years where we would see those big reverse premiums, the lower rents, beating other competition based on covenant rather than based on who pays the biggest premium. We're still not paying premiums for sites, but we are getting long rent frees, good reverse premiums. And we even now we're able to negotiate with landlords to not even have upwards only rent reviews. We're actually looking at just market value. So very, very attractive property market, and still loads on the market. And we think that this will continue for at least another 2 or 3 years. And then our cash position, if you already talked about the cash position, Toby.
Yeah, no, I talked about just the overall net debt position. So I mean, from the full year to now, we've remained at around that 5 million of cash, including cash in transit. Our net debt has increased by 4 million, but that's because we've spent 6.1 on capex and pre-opening for the 6 sites we've opened. But we've generated 2 on the EBITDA, and we have a positive working capital inflow because of the efficiency in contracts and being able to get better payment terms. That will see us in good stead as we go through 2023.
So that's it for sort of the update presentation, but we've got a number of really good questions that we are very happy to run through now, and any more that you have thought of or want to add. We've had a couple that have been added while we've been talking, so go ahead and write your questions in, and then we'll answer those.
Sarah, if I may just jump back in there, and Toby and Michael as well, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Guys, we did receive a number of pre-submitted questions, Sarah, as you did say, and we've also received a number of questions throughout your presentation this afternoon as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Michael, if I may hand back to you to chair the Q&A session with the team, and then I'll pick up from you at the end. Thank you.
Yes, certainly. Thank you. The first question goes, any expansion plans to countries outside of the UK, Ireland, Scandinavia, etc.? And the answer is a simple and easy one. The answer is no. We have so much scope for growth in the UK. We believe 150 sites. We are at least, and we are at 36 now. So we need to quadruple the size of the business before that becomes a topic. Next question is, given high inflation rates, what happens to leases? Are they linked to CPI from a cost basis? Sarah, would you like to take this one?
Yeah, so no, I mean, we're getting in at a very good low rents on the properties that we've gone in for. We're taking long-term leases, 5-yearly rent reviews, and in 5 years down the line, it is usually market rate, which actually has worked very, very well for us, certainly over the last few years, because of course market rates are a lot lower today than they were previously. So no, we don't tie in it. It's a buyer's market now. You don't tie into onerous leases like, you know, in the days when, I guess 10, 15 years ago, when actually if you wanted to get a really good site, you had to take on some pretty onerous terms and conditions within those leases. Those days have gone.
Thank you. And the next question is, given the difficult trading environment, have any firms that were on the watch list from an M&A perspective been open to advances with NIGHTCAP? And I mean, the answer there is that it's been a very complex trading environment for hospitality since March, April 2020. And with the various aspects around the macro on rail strikes, or whether it's the cost of living crisis or the increase in interest rates, they've all had a negative effect on independents in particular, which is what NIGHTCAP was built on, really. And so the answer is yes, there are more advances, there are more conversation. There is, I would say, a reasonable amount of fatigue after many years of not having a full year of normal trading. And so we are having more conversations, which I think we believe is also increased by the fact that interest rates are now not much less manageable. So we went through a COVID period where people had to take on a lot more debt to simply survive a lot of these COVID loans, and now that interest is at 4+, the situation is only getting more complex if you have a big debt pile. So yes, we are having more conversations, but that is also what we do. So there aren't really any surprises there. Next question is, noticed a fair amount of social media activity for the various bars. How is ROAS going in this environment? So basically the question here is it becoming more costly to attract, to spend marketing pounds to get direct revenue from it? And the answer is it's actually a little bit of a mix. On one hand, we are benefiting from having a more streamlined marketing infrastructure where we can optimize how we spend our marketing pounds, and we can also measure our return on investment better. But at the same time, and we've got to remember, we've talked about this before, but roughly 50% of our overall turnover or revenue for the year is pre-booked, and again, half of that, so roughly 25% of our overall revenue is pre-sold. So these are events that take place, such as bottomless brunches, etc. So that's actually ticketed sales in a similar way. So you would see it in an e-commerce business, and that's where marketing spend is much more directly measurable. And we have very good metrics there at the moment, but there's no doubt that social media platforms are becoming much more expensive places to acquire customers, simply because of the cost that all direct consumer businesses have seen from those platforms, and we are no exception. But there are many other ways of acquiring customers, and we're very happy with the return we're seeing. Sarah, I think
yes.
What would be the key learning from integrating Barrio, and what would you do differently?
I would say the key learning of integrating Barrio is no different than the key learnings of integrating any of the businesses. They're all exactly the same underlying business model. I mean, when you integrate a business into a group structure, you start with, first of all, making sure that you understand the people and how they operate, and that's what we first of all spend a lot of time doing is understanding the people as well as the core business. Then you have to ensure that everybody's on the same system, so that you are able to pull the right data. Literally, so you're comparing apples with apples. There's no point one person being on a till system that doesn't account for your cost of sales and your stock in the same way that another one does. You have to make sure that everybody operates in the same way. What would we do differently? I'm not sure we would do anything differently, actually. And I think even if I asked the team, they would say the same thing about Barrio. The Barrio team have integrated phenomenally well into the business. A lot of them have got group roles now. They're a great team. They were a very small team. We really love that business, and we just opened it was called the largest tequila bar in the world in Covent Garden, and we've opened that very successfully, and it's running really, really well. And the next part of that question is, given the nature of the Disrepute bar, is this a concept that could be rolled out? So I love Disrepute. It's aimed at slightly older market. Funnily enough, I love it than a lot of our other bars. It gets into the top 50 bars. It wins awards all the time. It's a phenomenal bar. The quality is outstanding. So couldn't have lots of Disreputes, that's for sure. But I would love to be able to roll out more of that type of really quality top end, where it's not about the high turnover, it's more of a sort of dwelling model. It's a different business model than a lot of our other brands, that even though they have the quality there, this is about, can you do 20 cocktails in 7 minutes? That's what we train. We train top end to keep serving that real quality. Disrepute, if anybody hasn't been, it's more like almost like a sort of New York not wine bar, but cocktail bar, sophisticated martini bar, really. But it does so well, not just in terms of its popularity, but also financially, it does really well as well. So yeah, I would love to, but it's a different team and it is a different business model.
And the next one is, there seems to be a significant cost saving with the establishment of combined group back office, £1.4 million. Can we break this down?
So a lot of that came from, sadly, when you do merge 3 businesses, you naturally need to lose some people. And partly some of those were redundancy, but also some of those were actually when there are people that have worked really hard and grown a business and it's 10 million turnover and 8 bars. they don't want to be part of, or don't have the skill set to be part of a business that does 60 million or 100 million turnover. It's a very, very different skill set. So when you grow this quickly, unfortunately, not everybody grows with you. And that means that people have to be replaced with some people who've just got the more relevant experience. You know, when you buy 3 businesses, you buy people who've started something from scratch. And that's a very different skill set. If you gave me a blank sheet of paper, I would literally just stare at it. I couldn't create it. But what I can do is walk into a bar and say, oh, I know how to have 100 of these, but I couldn't create the bar. So, you know, different people are great at different stages of business. So the majority of those savings are from staff. There's also some rent savings, because obviously we just got the one head office now. What that doesn't include actually is a lot of the great work that our new commercial director is making at the moment. A lot of the great savings that he's making in this group purchasing, group efficiency, where he's looking at the systems, and by merging all of the 36 businesses, that's hundreds and hundreds of thousands of pounds on an annualized basis, which isn't included in that 1.4.
Okay, I'll just skip quickly through the. Are we considering franchising our concept because of the success of them? And the answer is no. We believe in staying focused. It's the same reason why we're not looking at expanding overseas. We have lots to do here. We are on a mission to achieve that, and that's what we'll stick to. The next question is one for Toby, which is around, could you please outline what the 3.7 million in other payables are around trade payables, Toby?
Yes, well, that was a 2.3 million earn-out share deferred consideration for the ABG shareholders, which they successfully hit their targets in May 22. So that was paid out, and the other 0.9, so making up the majority of that balance, was the deferred consideration relating to the Barrio purchase. Because we purchased it right at the end of November, there was a completion accounts mechanism whereby once we true up all the accounts, there was a further £866,000 payment due to them, which was paid in the early part of 2022. The other part of the question was around tax and social security increasing, saying that that's not to do with PAYE, actually, because within that balance there's also VAT. So the bigger increase is the fact that we had our best ever Christmas, and therefore we took our best ever sales, and with the 20% of that on those sales has given us a increase in the tax and social security. There is a PAYE increase because we had 6 new bars, and whilst there's 6 bars, the way we sort of see it, it's almost quasi 12 to 15 bars by the size of them, because there's some really big footprint sites that we've opened. So hopefully that answers that question for you.
Thank you, Toby. So another question is, do you work with social media influencers to promote the business, and what impact has this had? The answer to that is yes, that is something we're considering more and more, both in terms of the types of spirits that we're using and who promotes those, and also on various social media platforms, particularly as we get deeper into various bits of content. So the answer is yes, but watch this space. I think there's another one talking about asking a question on any news on the shareholder discount perks promised at your last presentation. I wanted to pick that one out to say that it has required a bit more work on our back-end systems being fully integrated and working seamlessly together, so that it can actually be a NIGHTCAP initiative. But we are getting there. So hopefully I won't be having to say that next time as well. But we are actually getting there.
Yeah, I would go as far as to say it was actually on the agenda in our board meeting yesterday, which it really is. We really are making progress on it. It's a priority, because also having that tech and the ability to do it across all brands. One, needed them to be fully integrated. So now we are operating as a group, and that happened at the end of January. But of course, once that's in place, we can offer all kinds of things, loyalty cards. It's not just for shareholders. And so we are really excited about that. It's properly on the roadmap. So I promise we won't keep saying, yeah, it's coming. But the integration was the first step, because until everybody's on the same systems and till systems and accounting systems, things like that are just impossible.
There is then a question on, can you talk about the competition in this space? What sets you apart from others? That's a big question. I don't know who wants to jump in.
That is a really big question. I would say, so there's a couple of things. One, we are very good. I mean, we're the best parties, but as everybody says, lots of people say that. So it's not just about the party. It depends which brand you look at. We have late night licenses, and you can enjoy our sites throughout the day at the weekends by coming to one of our amazing bottomless brunches, which now is 25% of our turnover and doing very, very well. And that's a part of the business that we would not normally using a part of the day, a part of the week when we wouldn't normally have had that turnover. But the fact that we have the individual brands means that those brands remain so good. We're so early on in the development. They remain so good at what they do. And there are people who are real ambassadors within those brands that love what they do, that actually to the customer, we're still very, very new. We're still very fresh. We consider things like influencers and Instagram, and depending on which of the individual brands we're talking about, we just make sure that whatever our target market is on that particular night, we are just the best that's on offer. And in addition to that, you have to be, as Michael was talking about, the marketing, you have to be very, very good at communicating. You have to be very good at reaching your target market and letting them know that we are there, that you can book with us. We have an incredible team, and we don't dilute that team by having lots and lots of different other types of businesses within the group. We are the best at late night party bars. We're brilliant at it.
I think one thing to add is also that we're equally laser focused on the target market that we're trying to serve. We from the outset focused on Gen Z and millennials. It's the group with the highest disposable income, lots of need and desire for social interaction in safe environments, which is what we provide. And by sticking to that laser focus, it also means that our ability to reach that very targeted market and offering, you can go out 3 or 4 times in a week in some places now and go to a different venue and have a completely different experience, but loving the party equally. I'm not suggesting you should go out 3 or 4 times. I'm just saying if you did. So that is the other side of it. By staying focused on what we do, we are the best in that space.
And I think because we're new and exciting, and we're always moving with the time, that it helps a lot that people like Kendall Jenner posting about us this week to 250 million followers, saying that we're one of the places to go to in London. Things like that, when you have the big celebrity endorsements that we don't pay for but they love us, really helps. And it's important that we just keep that branding at forefront in mind.
I don't know, does she fall into millennial? She does she? Yes.
Then very much target market, very much.
For sure.
That's actually laser focus right there.
So, yeah, for sure. So what lessons can be taken from the rollout of the estate to date? Or have you done anything differently? And I think before handing to Sarah again on that one, I would just say that you're given Sarah's earlier answer on, only one of the 13 hasn't been basically a hit from day one. It's been more hard work. It sort of shows that when you can roll out that many sites in such a short period of time and have such a high hit rate, shows that we feel that we've been doing a lot right, even though we've also been experimenting with, for example, the cocktail club was traditionally small bars, and we've tried in different size formats, and they've all worked. We've tried to move to smaller places like Reading and Exeter, and have incredible success with that as well, which speaks both to the concepts of our ability to push, but also the property market and how attractive it is for landlords to have a great covenant like us come in those best locations that unfortunately no longer have a tenant, particularly post-COVID.
Yeah, I don't think there's much more to add there. I mean, I think, yeah, I don't think there's much more to add there. I think that with the rollout has been about flexing the models and making sure that we can continue to get the ROI that we came to market with, and we've needed to prove that across all of the brands, inside and outside of London, and with different sized businesses. So some businesses that we might spend 300 grand capex on, or 600 grand, the ROI has to remain the same. And by opening those 13, that's exactly what we've done, and that's exactly what we've proven. So now we feel very confident to go, right, this is where we're going next. That's where we're going next. We also needed to trial the cluster model, really important. Trialed it in Bristol, trialed it in Birmingham, we've trialed it in Shoreditch. All have worked really, really well. In fact, we are definitely better together, actually, in those areas than we are on our own. So there's a lot of lessons to be taken from it, a hell of a lot of lessons. And, you know, if we were sat with 20 million quid in the bank now, we know exactly what we would do with it and exactly where we would spend it.
So next question is, surely like-for-like sales are down 5% over last year. What was the cause of this?
I think we've talked about this. That's a range.
Yeah. I mean, the reality is, in last year we were north of 25% up in when Freedom Day and the second half of 2021. So we are still 10% up against 2019, and whilst being just over 5% down against last year, again, we've talked about we think we've lost over 8% of our sales from the rail strikes. Now, whilst they're not all like-for-like sales, a big swathe of them will be out of our 36 site portfolio. So I think once you factor that in, the fact that it probably has us pretty close to being like-for-like neutral against the year when we were over 25% up on the previous year is a fantastic 6 months result.
Next question is, hi team, thanks for the excellent presentation. Can you explain your rollout strategy outside of the cities you're in around the UK? For example, when you will be heading to cities in the north of England and Scotland?
Soon, as soon as we possibly.
The north of England, Liverpool is
yeah. We've opened in Liverpool. We've opened in Birmingham. Can't wait to open in Manchester, Leeds, Newcastle, Edinburgh, Glasgow. Where else have we looked at? Nottingham, Derby. We're not quite Stoke. I'm not sure Stoke's going to be in the first 150, but we're working on it. But no, I mean, we're absolutely ready to go to the north of England. The businesses outside of London are really, really doing well, So yeah, we can't wait to open some more.
I think that is the end of the questions, unless anybody has.
Michael, Sarah, Toby, absolutely. And thank you very much indeed for being so generous with your time then, addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, to then add any additional responses, of course, where it's appropriate to do so, and we'll publish those out on the Investor Meet Company platform. But Sarah, really just before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
It's just to say thank you, really. So thank you for those of you that already are investors for your continued support and coming on this journey with us. We're really, really proud of what we have achieved over the last 2 years. Thank you to our customers that continue to come out and drink in our bars. and continue to have great nights with us and continue to come back and now starting to drink in some of our other bars. And above all, thank you to our team. It's been an absolutely crazy year for them and for everybody, opening so many bars all over the country and having integrated all three of the businesses into a group structure. It's been never, ever a dull moment. We have a lot of fun together, but everybody works very, very hard. And so I think my biggest thanks has to go to them, because they make it all possible. But yeah, and thank you for joining us today. Really appreciate it.
Sarah, that's great. And Toby and Michael as well, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of NIGHTCAP PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.